September 15th, 2008, one of the most powerful banks in America, with over $600 billion in assets, collapsed overnight. No warning, no bailout, and within hours, the entire financial system started to panic. This wasn't just a bankruptcy, this was the moment that triggered the 2008 financial crisis. So the question is, how does a 158-year-old giant disappear in a single weekend? To understand this collapse, you need to go back. Lehman Brothers wasn't just any bank. It survived the Civil War, the Great Depression, 2 world wars. By the 2000s, it had become a Wall Street powerhouse, but there was one thing driving insane profits: real estate. At the time, the U.S. housing market looked unstoppable. Banks were giving loans to almost anyone. These risky loans were called subprime mortgages, and institutions like Lehman weren't just issuing them. They were turning them into complex financial products and selling them worldwide. For a while, it looked genius. Profits skyrocketed. Executives made billions. But underneath, something was seriously wrong. Here's where things get dangerous. Lehman didn't just invest in housing. They went all in. They borrowed massive amounts of money to buy mortgage assets. This is called leverage. At one point, Lehman's leverage ratio was over 30 to 1. That means for every $1 they had, they borrowed $30. Now imagine this. If asset prices drop just a little, the entire system collapses. And that's exactly what happened. In 2007, housing prices started falling. People couldn't repay loans. Defaults exploded. Suddenly, those safe investments became toxic. Other banks started backing away. Confidence disappeared, and Lehman, they were sitting on billions in worthless assets. Still, they tried to survive. They looked for buyers. They asked for government help. But this time, no one came. Here's the shocking part. Just months before collapsing, Lehman executives were publicly saying, "Everything is under control." Behind the scenes, they were using accounting tricks to temporarily hide how bad things really were. One method, Repo 105, it allowed them to move debt off their balance sheet just long enough to look financially stable. But it was an illusion. By September 2008, the truth couldn't be hidden anymore. Buyers walked away. The government refused to bail them out. And on September 15th, 2008, Lehman Brothers filed for bankruptcy, the largest in U.S. history. The collapse didn't just end one company. It triggered global chaos. Stock markets crashed. Banks stopped trusting each other. Millions of people lost jobs, homes, savings. The ripple effect spread across the world. This moment became the turning point of the 2008 financial crisis. And the biggest lesson? Size doesn't equal safety. Profit without risk control leads to collapse. And sometimes, the system only looks strong until one piece falls apart. If this story changed the way you see money and power, hit like and subscribe for more deep dives like this. Comment below. What story should we uncover next? Thanks for watching. Stay curious, stay informed, and I'll see you in the next video.